within this country. Now, you have, when it comes to corporations, two types. You have C Corps and you have S Corps. Now, most of the time when filing on our end of the business with tax offices such as yourself, it's mostly S Corps. And those are typically smaller corporations that have some very nice tax benefits. Now, the last one that we wanted to discuss today was the limited liability company. The limited liability company, one of the best ways to describe that is kind of like a hybrid between the corporation and the sole proprietorship. It's got its own set of rules, but what it does is it allows someone to start a business without incorporating and protect themselves from business liability. See, if you start a sole proprietorship or a partnership, there is not much legal protection for you. If that organization ends up in a lawsuit with someone, they could come after that sole proprietor or that partner's personal assets. So a limited liability is very similar to the sole proprietorship and partnership in the fact that they're typically smaller and there's not as many rules associated with them as a corporation, but it shields them from the personal liability associated with their taxes. Now, single member LLCs do file most of the time Schedule Cs. So as far as our business types here, we talked about sole proprietorships probably make up the bulk of your Schedule Cs. Partnerships have their own return, 1065. Corporations have their own returns, 1120, 1120S. And a lot of limited liability companies will also file a Schedule C. Now, tax trivia, if anybody's taking note, there is a particular type of partnership that can file a Schedule C, and that is a qualified joint venture. So if you're working with your spouse and you've got a partnership between just the two of you, both of you can actually file split Schedule Cs with your own self-employment calculations, your own calculations on each one of them, and file Schedule Cs instead of partnerships. So technically we could have a Schedule C for three of those, but the first and the fourth will be the vast majority of what we're working with. So if you're going to be filing a Schedule C, which is our topic today, your sole proprietorship or a single member LLC, you're going to need the following information. You're going to need your income statement and balance sheet for that tax season. Now, when it comes to the income statement, when we look at the Schedule C, you'll see that it's almost just an income statement. Obviously, there's some more information on it, some things we got to complete, but it's essentially an income statement, the Schedule C is. It's revenue minus expenses equals your profit. You're going to need receipts for your business expenses. Very nice if you have professionally prepared books, especially when it comes to business expenses. And we'll talk about how TBP can help with that in just a little while. You need inventory records, and we'll talk about inventory as we move through today's presentation, because inventory can kind of be tricky for first-time business owners about the tax purposes and how that works with inventory. So you got to have specific records when it comes to inventory. Then you got to have mileage or other vehicle records if you used your car for your business. And almost every Schedule C out there is going to have some type of mileage associated with it. And we just had a presentation last week on vehicle expenses, and we took a lot of time talking about standard mileage versus actual expenses with depreciation. That particular presentation is on YouTube right now. Just go to YouTube, search for TBP Pro, and feel free to check out that free informational webinar as well. But these are the typical things that we need to file the Schedule C. Now we're going to start looking at the breakdown of the Schedule C. And if you remember, we talked about it a little bit earlier. The Schedule C, if we strip away some of the things like the name and address and method of accounting, we're looking at an income statement. We're looking at what you bring in, what you spend, and what's your profit. Now, we got some calculations going into that. We got some things that we have to do on top of that or send it to other forms, but we're essentially looking at a Schedule C. So part one starts with the same thing as the top of an income statement. It wants to know your income. And if you're looking at this example that I pulled directly from our tax preparation software, and excuse the mouse moving everywhere, I'm just moving my video feed for just a second. If you look at that, it starts with the gross receipt or sales. And we're going to enter that information, and the software is going to start calculating down. But what we're trying to get is we're trying to get gross income. And gross income, for simplistic purposes, is your gross receipts minus your cost of goods sold. And we'll talk about cost of goods sold because we actually calculate that on another part of the Schedule C. Also, please keep in mind when you're dealing with a Schedule C that that particular person might have been paid via a 1099 miscellaneous or 1099-C or a 1099-K. Those forms will typically need to be a part of the tax return as well, and that information will need to flow through the Schedule C. So what we're doing is some of this is gross receipts or sales. Some of that we're just going to enter ourselves. If they've got a 1099 miscellaneous or K, that's still income that we made. We still need that income reported on the Schedule C. So what we need to do is make sure that all the income for the year, if we've got 1099 miscellaneous, 1099-K, that we're not double counting that we would remove that from the gross number at the top. Because say this number was 125 and 20,000 of that was from a 1099 miscellaneous, a single job. We don't want to show revenue of 145,000 if we've already counted the total revenue on this box one. And as we get into the software a little bit more, I think that'll get more clear. We just want to make sure that we're appropriately accounting for the 1099s that could be associated with a Schedule C. From there, we're going to calculate all the way down to where we get our gross income. So as we just said, that's our revenue, that's our total income, minus what we've spent on cost of goods sold. Now, not every business is going to have cost of goods sold. And just to simplify that, let's just call that inventory for now. People doing services such as landscaping and things like that aren't going to have cost of goods sold usually. So that's going to give us our gross income. So we're going to take our gross receipt minus our cost of goods sold. We're going to take our gross income. We're going down to part two. And part two is what a lot of people are very familiar with. This is where we list out our expenses. And just giving you an example here, just plugging in some number. So the IRS designs the Schedule C. And they'll change it from year to year, but these things stay kind of common. This is what the IRS wants to see. They want to see the breakdown of these expenses to these categories. And if you look line 8 all the way through line 26, they don't want to see just one big lump number. They want to see the breakdown of this. So for example, I've got advertising, car and truck expenses. Keep that one in mind as we keep moving on. Contract labor, depreciation, another one that we'll touch base in when we get into the software. Legal professional services, so on and so forth. This is where we want to have the breakdown. And it's very nice when we have a client, a business owner client that has professionally prepared books done, because this part's pretty much done for us already. So a lot of people that are also offering bookkeeping on top of their tax preparation, they either put in a big discount or they do the tax return as part of that. Because with professionally prepared books, you've got 99% of the work already done. You're just plugging in these numbers. Or if you're using a software that can integrate, you're just sending these numbers straight into the return. A couple of things to point out when it comes to these expenses, like line 13 for depreciation, that's one of those fields that we're going to take a little bit of time and look over. Also, keep in mind, we had another informational webinar on depreciation, again, on YouTube, if you want to go check that out. But that typically comes from some complex calculations that the software is doing. Also, if you look down at the bottom on line 26, this can be a pitfall, for people preparing their first Schedule Cs because they want to put a certain number in here for the owner, or perhaps what the owner took out of the Schedule C, something like that. Typically, Schedule C or single member LLC clients are what's referred to as disregarded entities with the IRS. What that means is if you're a sole proprietorship or single member LLC filing a Schedule C, the IRS really doesn't care how much money you take out of that business. If it's income to that business, it's income to you. Doesn't matter if you left it in the business bank account. And you get that question a lot, or at least I do on my end, doing some taxes and accounting myself. Well, yeah, I brought in 20,000, but I only took 10,000 for myself. And I say, well, the IRS says you took 20,000 for yourself, at least on this tax return. So that line 26 for wages, that is really what you have paid to W-2 employees with properly filed payroll. People that have had withholding taken out, people that have had the Social Security, the Medicare taken out of those wages. And that's your net amount that's been paid to wages there. Contract labor on line 11, that's for contract work in which you're not necessarily paying wages and you can pay a flat rate without any withholding or employment taxes on your own. So just wanted to point out those two pitfalls and make sure we understand the difference. When it comes to the Schedule C income of the owner of the business, that's going to end up being your bottom line. That's what the business made. Doesn't matter what they paid themselves, what they take out, that's their bottom line most of the time. Contract labor are people that are paid by that individual as contract labor without any withholding. And then you got wages, which are your W-2 employees, which are properly filed payroll with 941s, 940s, etc. Just want to point those out, make sure that we're good to go on those. And also keep in mind, if you can put it in lines 8 through 26, do it. The IRS puts these categories there for a reason. They want to see that breakdown. They've got certain formulas and things that they could use to look at a Schedule C. So they want to see these numbers in these categories, not lumped up at the bottom as other and then carried over to line 27. One of the red flags that could increase your chances of an audit. So that's our business expense section. So at that point, we've got a pretty good idea of what this company made because we've got our income, we've got our minus expenses. But if you'll remember, we came on part 1, we talked about line 4, cost of goods sold. And let's talk about that for a second because inventory can trip up a lot of small business owners and a lot of tax professionals doing their first Schedule C. And we don't want that to happen. That's one reason TBP hosts these informational webinars to get this information in front of you. Now let's just talk about inventory for a while. Typically the rule with inventory is we're not counting it as an expense until that inventory or some inventory before it has been sold. And that's not something that a lot of people think going in. They go in, they start a business, and some of them actually make the mistake of starting a business in December, spending a ton of money on inventory. And they think they've got this huge write-off. And they actually don't at that point because they don't have any purchases to go along with that inventory. So inventory is calculated to where you actually look at your inventory at the beginning of the year. So if I've got $30,000 worth of apples, right? That's what I had January 1st for this upcoming tax season. Then $54,000 of them were sold for that particular year. Now, what I also need to look at is that's my total cost right here minus my inventory at the end of the year. So you see, if that inventory hasn't been sold yet, I'm not counting it as my cost of goods sold. See, my total cost, what I had at the beginning of the year and my purchases that I made was actually $84,040. But since I have inventory at the end of the year, I only get to count the $68,720. So keep in mind, that's how it works with inventory. It's what you have and what's actually purchased for that particular tax year. And I'm not exactly sure of the reasoning behind this law, but it's my strong assumption. It's just something put in place to keep businesses from making large inventory purchases at the end of the year to pull down their tax liability, would be my guess. But inventory going to be calculated a little bit different. So if you're dealing with a new business, you're not going to have any inventory at the beginning of the year. And then everything you buy for that year is a purchase for that inventory, right? But then we look at what we have left over. If we didn't sell that inventory, we're not counting that as a cost of goods sold for this particular tax season. Matter of fact, that 1532 for this next tax return is going to be line 35 for the next year. So it'll be there, the inventory at the beginning of the year. So just something to keep in mind when you're calculating your cost of goods sold and explaining this to your clients. When it comes to inventory, it's what you purchase and sell for that particular tax year. Keep that in mind. Part 4 is specifically related to vehicle expenses. So part 4 is just a nice way to come in and calculate your standard mileage. As we were talking about earlier, most Schedule Cs are going to have some kind of mileage. And we talked about this last week. We're not counting going back and forth to the office. But if you need to go visit a client, if you have a remote job, that's where you're going to have those business mileage. You want to keep a log. Matter of fact, look at your questions at the bottom. Do you have evidence to support your deduction? And is the evidence written? Now we now know that because of modern technology, written doesn't have to mean pen and paper. It can be one of the nice mileage tracking apps that a lot of people use too. But when it comes to this vehicle expenses, we want to make sure that we are keeping a mileage log and something that's either on paper or electronically stored, because that's what the IRS requires business owners to do. So part 4 is pretty simple, pretty straightforward. This is where we enter our business mileage information. Now, and I'll show you this once we get into the software, but what we do is once you enter it there, it'll actually carry it to line 9 for you. So you enter the mileage on part 4, and line 9 will be calculated for you, and thanks to the built-in calculations, immediately taken off your income. One more section that we'll talk about, and then we'll pause for questions, is part 5. And part 5 is your wild card, if you will. Part 5 allows you to go in and list out other expenses that were not, in part 2. So if you don't see a spot for it in part 2, come down to part 5, list it out, list the amounts. It's going to total and put that in your expenses, and it tells you here on line 27A. So this is your wild card, your other expenses. Piece of advice, only use this if you have to. Remember, the IRS puts those categories on a Schedule C for a reason. That's what they want to see. This is if you can't find it and where it's going elsewhere. So resist the urge to come down and put a lot of things under other expenses, especially when they give you like a handwritten note of all their expenses. Try to find them in the expense categories in part 2, and certainly don't lump everything on the other expenses right here and let that go. So that's what I wanted to cover as far as parts 1 through 5 on the Schedule C. That's the breakdown of it. Very quick summary. Sales and cost of goods sold is how we start, giving us our gross income. Then we look at our business expenses on part 2. Our part 3 actually gives us a number for our part 1 calculation, some government efficiency for you, but that allows you to get the calculated cost of goods sold that helps you calculate your gross profit. Part 4, your vehicle expenses, where you're typically listing your standard mileage to get that line 9 filled in. And part 5, anything else. And we only use this one if we have to. So let's pause for a minute and see what questions we have on the chat or anything like that. If anybody wants to unmute and speak, that is fine as well.
Yes, Jason, I also want to take the opportunity to welcome. We have more people that joined. I want to say welcome and to remind you that this webinar is brought to you by TBP Pro. And we have Jason Garner, who's our president. He's talking about Schedule C. Jason, I see George has a question. He asks, can you address a bit about meals?
Absolutely. So when it comes to meals, we've got some rules that we've got to follow. Like if you're at work and you go get lunch, we're probably not counting that as a meal expense for that particular business. Now, what the IRS wants to see is certain meals count and certain don't. And let me get back to our expense section here. Also, notice on meals, meals has a breakdown box just to the left. And most of you probably already know what that's for. Most of the business meals that you're that you're expensing are going to be at 50%. So you spend $100, you got a $50 tax write-off. So your tax income is going to be different than your book income, and that happens. So when it comes to meal, first rule, most of them are going to be 50%. There's some exceptions, with everything in taxes, there's exceptions. Going to be some exceptions to that, but 50%. And that's why we have this box off to the left here, because and we'll see this when we get into the software. If we put a number there, it's going to give us 50%. Now, the other thing is when it comes to meals, we need to be traveling with overnight travel away from home, or it needs to be a meeting in which business is discussed and expected. So you go to a meeting with a lunch with a potential client, you pay, you've got a meal deduction. Once again, we use the example, say it's $100, it's a very nice lunch. You put $100 in 24B, in this box to the left, and that's going to carry $50 over for you. So you're traveling away from home overnight, you need to eat. When you buy meals, that's going to be a 50% deduction. So those are the two main ways in which we're going to look at meals. We're going to look at business meetings, discussing and expecting business, and overnight travel. And our typical rule for that is going to be a 50% tax deduction.
All right, let me see. He said landscapers eat while working. How this should be treated?
Landscapers eating while working. Now, typically, it's going to be my understanding, if they're not traveling overnight away from home, that meal is not going to be tax deductible because they're going to have the option to bring a lunch with them. And I don't know if that's the justification for that law, that tax rule on that. But I would not consider a landscaper who's coming back home that evening to have a meal on site or to go get some fast food a business deduction in that case. Fair enough on that? Let's see the thanks. You're very welcome. All right, I'll pause for just a couple moments, and if we're good, we'll move on.
Yes, I see Clem says it is same as Santos, eating and working.
I think I know what he meant. All right, thank you, Clem. All right, we will definitely pause for questions again. So just let us know if you got them. So we're going to keep moving on. And next, we're going to talk about forms that are typically related to the Schedule C. Now, a lot of times you file a Schedule C, you're going to have other forms that are required on that tax return. One of the most common is going to be Schedule SE, and most people hate this form. I call it the refund killer. Self-employment tax. So just a brief overview on how that works. When you're paid wages by an employer as a regular employee, usually that employer pays half of your employment tax. So that money that you have, if you look at your pay stub, going out to Social Security and Medicare, you've got deductions for that. You see it on your W-2, you see it on every pay stub. That number actually collected is doubled because the person paying you is also paying that much. So IRS doesn't want to let any money get away from them. So what they do, if you're working for yourself, what they do is they say, well, you're the employee and the employer. So we're going to charge self-employment tax. So what that means is there's an additional tax to cover the employer part of the employment taxes. So self-employment tax. And that form in our software is typically added automatically and typically calculated automatically without any additional work that's going to be done on your end. But a lot of people are surprised by it because it can add up rather quickly when it comes to people that become successful with their small businesses, and some of them don't see it coming. So us as tax professionals, very good for us to stay out in front of that. Maybe perhaps do a mid-year review with our Schedule C clients. Certainly offer to keep their books and make sure that we're staying on top of that. Form 4562 has to specifically do with depreciation. And like I said, we just had an informational webinar on depreciation, but that's the form that shows the calculations for depreciation. Now, a lot of times, and I'll show you an example when we get into the software, when a business buys an asset, a more than 1 year asset, they need to depreciate that asset. And what that means is the IRS gives you a useful life, and it wants you, and this is just an oversimplified example, it wants you to divide that out for a certain number of years. Like, for example, you buy a computer that costs $300 and say it has a useful life of 3 years. The IRS wants you to take a $100, $100, and a $100 deduction for the next 3 years. And that's something we'll look at as well. 1099 miscellaneous and 1099K are forms that we alluded to earlier with part 1. We want to make sure those are properly reported, because when an individual gets a 1099 miscellaneous, that needs to be part of their tax return, because that's going to be filed with the IRS as well and with Social Security. And the IRS is wanting to see that particular EIN or Social Security number of that 1099 on that return. So a 1099 miscellaneous is like the brother of the W-2. The W-2 is what you get when you make money working for someone. The 1099 is the form you get working as an independent contractor for someone. So they didn't withhold taxes, and we talked about that already. You'll get that form. And 1099K, that's the form a lot of merchant services are sending out right now. So if you're accepting credit cards, you are probably getting a 1099K because the IRS wanted to see another form. They wanted more tracking. Imagine that. They wanted to see where the money was coming from and who's making it. They want to see more tracking on those merchant services and make sure that they're accounted for as revenue. So those are your typically supported forms. And at this point, we're actually going to move into the software and take a look at the Schedule C and also those forms. I'll move into the TBP Desktop software, and moving along with our example about selling apples, I've got a Schedule C for someone selling apples. And this is what my Schedule C looks like: profit or loss from business. And on this particular return, we're starting at the top on this Schedule C. We simply enter a principal, business, or profession. And that's just us saying what that business is. And then one of the more fun parts, and I say that in jest with a Schedule C, is choosing a business code. This business code needs to be entered on a Schedule C, and it just looks good, and it helps, with the IRS making the return look very professional and legitimized. This business code reflects what type of business it is. In this case, fruit or vegetable market. We're selling apples, right? So this code is a 6-digit number. And we actually have this choice list at the bottom of our software that allows you to find this in this list. And as you can see, there are quite a few of them to choose from. But that's just because there's lots of different businesses. Now, let me show you this. I picked up a little trick in the software that I'd love to share with you today. Before going to the list and trying to find it in this long list, come over to the description and type in what you're looking for. Let's try landscaping. LA finds landscaping. We press enter. There's my business code for landscaping. Nice time-saving, error-proofing feature built in the TBP desktop. We had fruit, so I'm just going to type in fruit again. It finds fruit. Fruit and vegetable preserving in this case. We'll enter that and we'll take that for now. We move down. Address for the particular business. If it's the same address, a home-based business, we can check this box, and that'll bring in from our client data the address for this particular taxpayer. We'll move our way down, and we've just got some basic questions that we need to answer at the top here. Like, for example, the accounting method. Now, the overwhelming majority of Schedule Cs are going to be a cash accounting method, and that's just basically when, I count it as income when I get the money. I count it as an expense when I spend the money. Now, there is the accrual method, which usually is larger businesses, and they have different rules that they have to follow when it comes to when do I count the income, when do I count the expense, so on and so forth. Most of the small businesses in the country, most of the Schedule Cs, overwhelming majority, going to be the cash method. Then we got a couple of questions. Did you materially participate? So did you put money into the business and work with the business for that year? Because that's important if you're going to have a loss on the Schedule C. We want to make sure that we have that accurately reported on this return. Did you start or acquire the business in the current year? Did you make any payments that would require you to file Form 1099? We talked about this already. Why would you have to file Form 1099? If you hired an independent contractor, if you hired someone that wasn't an employee to do some work and paid them over $600, technically you should be filing a 1099. And the IRS wants to know those questions to answer yes or no for those. You've got a next section here that has created a lot of confusion for the past few years, the Qualified Business Income Indicator. And you can Google this as much as you want, go to the IRS website, and I think twice now they've tried to produce and distribute clarification on this particular one. This was a tax credit. I believe it was part of the Trump tax law changes that allows a credit for small businesses to pay less taxes. So if they are qualified, and that's part of our choice list for here, if they are a qualified trade or business, they can select that queue. And then there's a certain deduction or a credit that they are allowed before paying the full amount on their income. A couple of other boxes here just to point out a few of them. Like, for example, an exemption from self-employment tax. That's fantastic as far as helping your refund, but certainly don't check that button unless you have a bona fide reason to exempt from self-employment tax, because you're probably paying self-employment tax. That's just a way to opt out of it. There are a few examples where you can use it, but be very careful with that. We'll come down to part one, and this should look very familiar. These are the screenshots that we looked through. I just want to point out a few things. Notice the real-time calculations of the software as we type information in. You see the lines moving down, calculating my gross income. So real-time calculations and heads-down data entry to make sure you see what's going on with this tax return as you're working. There's also this next box, income from 1099 miscellaneous, 1099-C, and 1099-K. Notice the first box is a light blue field. Second box is dark gray. With TBP Desktop, a small rhyme that you can help yourself remember. Light blue, that's you. Dark gray, stay away. Dark gray are calculated fields. So this is where the software is sending the income from the 1099 miscellaneous or 1099-K if applicable. So if this particular person also had a 1099 miscellaneous that was part of their income, what we would do is we would go to add form. We can type in 1099, find our 1099s very easily and quickly. And let's add a 1099 miscellaneous. We now have a 1099 miscellaneous. We now have it in our forms tree on the left. Actually, the second one I've added to this particular return. But what this does a lot of the times with the 1099 miscellaneous and Schedule C, the amount of income is going to be on line 7, non-employee. And we talked about that earlier. You've got contract workers and you got employees. Employees, you got properly filed payroll that you got to do. Contractors, we can do is issue the 1099, pay them and move on. This is where we put our amount here. Because remember, the IRS wants to see this number. They want to see this EIN because someone filed this with them. So they want to see this in the tax return, but it's a Schedule C. So what we do is on this box below, it says link to. And some of you are already figuring this out, and some of you have seen this 100 times. But this is where we click choices, and we send this to our Schedule C. Now also, one more box to check, self-employment and EIC. Chances are that's going to be X. If you look down at the bottom of the screen, check if subject to self-employment tax. More than likely, it is going to be self-employment tax, and we want to make sure we account for that, because if we get a letter later on because we didn't check that box, then we're going to have some unhappy taxpayers coming back. But we're tax professionals. TBP's in our corner. We listen to the informational webinars. We know that 99 times out of 100, get a 1099 miscellaneous on a Schedule C, that's self-employment tax. So we check that box. Now, I go back to my Schedule C. Notice I've got 4,000 linked over from the 1099 miscellaneous. And the 1099K works the same exact way. If I go to add form, type in 1099, find my 1099K in my forms list. Notice it has a link to Schedule C, E, or F as well. So I can link that directly to any number of my Schedule Cs, because you could have serial entrepreneurs that have 2 or more Schedule Cs, just like so. Now also keep in mind, when doing that, say you had prepared this return and then they said, oh yeah, I got this 1099. If this 125 was their income for the year, it already included that 4,000. You would need to still put that 1099 in there, just because that's been filed already, right? Very similar to a W-2. So what you'd want to do is minus this number, the 4,000. And don't know if anybody's using this functionality already, but within TBP Desktop, you can click on Calculator, click on Get, and have that number popped right in your calculator, minus 4,000 equals, and insert. And I've reduced this number by 4,000. So now my income, my line 1, my gross receipts or sales, is still equal to what it needs to be, the actual money that they brought in. It just happens that 4,000 of it was reported on that 1099 miscellaneous. As I scroll down to part 2, looking at my Schedule C, these are my expenses. And for the most part, these are very easy to enter. You get the total amount they spent on advertising. Enter the number. Now, with some of these, and I'll show you on line 10, commission and fees. Maybe you want to break this down to the different types of fees that you're paying. Use a keyboard shortcut, Control W, and TBP Pro Desktop for an overflow line. And then you can list out the different fees, just like so. And that number is going to total and carry up to that line, but at the same time, give you a nice list if you ever need to come back in and see the breakdown of that. That's Control W, W as in worksheets, if you want to take advantage of that. So you see my total here, and the rest of these are just filling in expenses. And we talked about this, we had the good question about meals. Let's type in a nice even number so we can see that calculation. $500. We get a tax deduction though of $250. Remember, we got a 50% deduction on those, except for DOT, Department of Transportation employees, and you can see that little checkbox to the right here. And I encourage you to look that one up if you've got some Department of Transportation employees. The software is going to automatically calculate all of these for me and give me a total number of expenses. And then we're going to take our total income, which is on line 7, real-time calculation, minus total expenses, gives us a tentative profit or loss. So that's my profit, or my income, because remember we said Schedule C is pretty much a big income statement for this particular business. But we've only gone through part 1 and part 2 so far. So let's keep going. Part 3, we specifically talked about cost of goods sold, or most of the time inventory. And remember, inventory's got that tricky calculation that a lot of business owners aren't going to consider when they're doing this. Now, what we need to know is the inventory at the beginning of the year, how many purchases they made, and their inventory left over, or what they didn't sell at the end of the year. So like if they didn't sell much at all, let's go back and say we had 70,000 still in inventory. This very much affects my tax calculation because I still have a lot of inventory. I don't have a big cost of goods sold expense. So if I look up here, my income has now went to $82,000 because I have lost almost all my cost of goods sold. So cost of goods sold is a very important calculation for anyone with inventory, cost of goods sold, retail, however you want to look at it. You want to make sure you're accurately reporting inventory at the beginning of the year, what they purchased, and inventory at the end of the year. I'm going to pull this number back down to 15,000. And that's going to put our number right back to where we had it on our profit. Real-time calculations, so you can not only do this, but you can easily explain this to your clients as well. Part 4, information on your vehicle. This is a simple calculation that's taking place. The number of business miles that you enter on line 44A is going to be multiplied by the IRS rate for that tax year. So you're not going to have to look it up. You're not going to have to pull out the calculator. And it's going to take this roughly around 50 cents per mile, a little bit more. So it's going to be about half. And if you see here on car and truck expenses, I've got about half of that expense as my car and truck expense. Now, we talked about last week how to do that versus actual with depreciation. Again, I encourage you to check that out on YouTube. And we'll also do that one again once we run through our series. Part 5, other expenses. In this case, I just put postage, nice, clear example. Doesn't just say miscellaneous, not just a huge number. So I just put postage here and an amount. Whatever I put here, I want to describe it. I want to total it. The software is going to total it here on line 48, and it's going to enter on line 27A, giving me, sorry for the scrolling, but giving me 27A other expenses, and then calculating with my net profit. So again, a Schedule C is essentially an income statement. Yeah, it's got some other stuff like the business code and things like that, but it wants to know how much money you brought in and what you spent to make that money. Now, it's got some other parts like the cost of goods sold and the vehicles, but hopefully today you got a good base on understanding how that works and how that's going to be calculated in your client's tax returns, helping you maximize their taxes and pay less. That's what we're all trying to do. If we can take advantage of a tax loophole, if we can take advantage, maybe loophole has a negative connotation, but maybe a tax law and pay less taxes, that's what we want to do. That's how we want to do it. That's what you want to relay to your clients. Let's pause, see if we have any questions before we take a brief look at the Schedule SE and the 4562.
Hey, Jason. Yes, there's another question from George. He's asking about the 1099 NEC. Can you address this old form coming back this year?
You know, I cannot, because if that is an old form coming back this year, I need to see what that is going to look like. So as far as addressing that today, Jorge, thank you very much for the question, but I'm going to have to get back to you on that one or come back to that one at a little bit later time, just because I want to make sure that I'm getting the most accurate information to this group as possible. So I will definitely look into that and see if I can get some information out to the TBP community about that.
Great. Any other question?
But a very good question. I appreciate it, and we'll research that. And thanks for the feedback. All right. And let's wrap up what we're doing in the software with just a couple little things. And we will go just a few minutes over 3, but not too long at all, I promise. The Schedule SE, or the self-employment tax, some pretty complex calculations going on in here. Nothing to worry about with TBP Pro Desktop. All these, remember, light blue, that's you. Dark gray, stay away. Guess what? All these are dark gray. Yeah, there's some other ones over here. I don't think you'll be using those a whole lot. So these are all calculated for you, even to the point of what is your self-employment going to be. But then at the same time, even though you're paying that self-employment tax, you get a deduction of half of it that's going to count against your total income. So another kind of complex topic, not to get in too deep today. Just keep in mind with TBP Pro Desktop, that self-employment tax and that deduction that your client should be getting when he or she is paying self-employment tax is calculated automatically. The other one we wanted to talk about was the 4562, and this is our depreciation form. Again, calculated for you automatically. And we did do that section on depreciation a few weeks ago, but depreciating assets are so easy in TBP Desktop. I want to show you again very quickly. I'm going to go to Add Form and click on my Depreciation tab. You can see that I depreciated a building. I was actually just working with someone earlier on something. I'm going to click on New Example, and I'm going to depreciate a computer. I need to know 3 things to depreciate an asset. I need to know what it is, when they bought it, and I need to know how much they paid for it. So I know what it is, I know when they bought it, and since I know what it is, I pick it from these class codes. And these are straight from the IRS. These are what they want you to pick, and this is your recommended way to depreciate this particular computer. And if you'll look, we got a 5-year life on this. So I just pick computer, and I just enter the price. I'm done depreciating assets. And like I said, we had a whole class on this earlier. Just want to briefly do this to show you the 4562. Software says, hey, this particular asset would qualify for bonus depreciation. And that's basically grabbing more depreciation that year, pretty much counting the whole thing off. It's just a tax code we can take advantage of if we need a bigger deduction for that current year. And all I got to do is click OK. For today, though, for simplicity's purposes, I'm going to opt out of it just to show you the depreciation calculations. So I'm going to opt out by checking this box. Click OK. Close. If I go back to my Schedule C, oh, wrong Schedule C. You can have multiple ones. Now, on depreciation, that amount has went up by $100. This 4562 is completely done. No additional work on my end. So that's what I wanted to show you as far as the supporting forms. We looked at all 4 of them, 1099 miscellaneous, 1099K, 4562, and schedule self-employment. What do you need to know about most of them for today's purposes? TBP's got your back. Automatic calculations take place. You focus on getting the most for your clients. And with that, we'll move back into the presentation and officially start to wrap things up today. Here are some resources that I put together for you. And again, this video is also going to be recorded and put on our YouTube page. But as far as preparing this presentation, I always use irs.gov. That's a great resource that I'm sure most of you are very well aware of. There's a specific one about the Schedule C. Publication 334 is for small businesses. And also another link when it comes to deducting business expenses. And again, these will be placed on YouTube and within our SmartNet application. I think I see a couple of chats coming up. I'm going to wrap up and take those questions just by telling you, when it comes to our desktop application, you can look forward to the most reliable desktop application in the industry. You can text clients directly from the application, grab remote signatures by sending a link to their phone, streamline tax preparation, including due diligence requirements. I should put another note on here, very streamlined and easy Schedule Cs, built-in document management, multi-office setup, deep discounts if you're doing bank product, and also industry-leading rebates to go along with those bank products. We mentioned earlier how clients filing Schedule Cs, it's very advantageous for them to have bookkeeping, professionally prepared books. And if you're paying someone, if you're paying a regular employee, you have to have professionally prepared payroll. Well, you have to have properly prepared payroll. TBP allows you to offer these services in days because we have a proven system in which we do most of the work and even provide you with a client management system. So if you'd like some more information about that, definitely check out our website or give us a call. Last but certainly not least, if you're looking to get into the mobile app world and also be ready for a COVID-19 tax season, which is what we're looking at in just a few months, definitely take some time to look at our mobile app. We're apart from the competition, and ours is directly downloaded from the App Store with live meetings and taking payments, all from the safety of their home. That wraps up our presentation. I know I saw a few chat notifications come in. We'll look at those questions, but we do always end our presentation with an invitation, if you haven't done so already, to join TBP Pro, and let's turn your office into a year-round revenue machine.
All right, thank you, Jason. We do have a few questions, I think 2 questions in the chat. I think Eddie says, my understanding is the new 1099 NSC form replaces the old 1099 MISC for non-employee compensation.
Fantastic to hear that. And if that's going to be the case, and I thank you, Eddie, for that, and that does sound correct. With that being the case, then the software will have that automatically updated with that new 1099 NEC, and we'll have the method put in place to make sure that you can link that to that Schedule C. And I've got to assume that's going to be a very similar process of needing to report that 1099 NEC and then linking that to the Schedule C. So thank you, Eddie, for bringing that up. I appreciate that.
Right. Also, there's another question from Tony. He's asking, can you have more than one Schedule C? Some clients have like 3 jobs like Uber, Lyft, or DoorDash. So do we create more than one Schedule C?
You absolutely can. And in TBP Desktop, it's as simple as just adding a Schedule C and then adding another one. Matter of fact, the return we were looking at today did have the 2 Schedule Cs in it. So absolutely, you can have more than one Schedule C.
All right. Thank you, Jason. Any other question? We have
My pleasure.
Well, we're over now. But if you have any question, any final question, we can answer that. Let's see. Tony say thanks.
You're very welcome.
All right. So I think let's wrap it up, Jason. I want to take the opportunity to thank you all for participating in today's webinar. I want to also remind you that every week we have webinars covering different topics. So I will also encourage you to visit our website, which is tbppro.com, tbppro.com. I'm going to put it in the chat so you can check it out. We have, like I said, we have weekly webinars, and also you can learn more about our software, the mobile app, like Jason mentioned, and also be part of the community. We're building the largest tax preparers community in the nation. So we want you to be part of it. So we're very glad to have you today. Jason?
Absolutely. Thank you again, everybody, for joining. Been a pleasure working with you today. Have a great day.
Awesome. Bye.